Hello everyone, welcome to Lineup Stocks. I'm Will. Today is March 13th, 2026, and let's get into our weekend review. This week's price action basically put us right back at square one. Monday's open ended up being the weekend's close, and right now, the overall risk-off sentiment in the market is incredibly heavy. It's been 2 weeks since the US and Israel launched strikes on Iran. Now, the globe's focus is entirely on the Strait of Hormuz. Because Iran has blocked the strait, Brent crude oil has pushed past the $100 mark. If this blockade drags on, it's going to have a massive impact on global energy and the broader economy. Recently, Iran threatened to attack 3 major UAE civilian ports, urging immediate evacuations over unverified claims that US forces used them. Meanwhile, President Donald Trump urged international allies to deploy ships to secure the Strait of Hormuz. How and when the US and Israel resolve this issue is the market's main focus, which is exactly why indices are showing such strong risk-averse behavior here. Furthermore, Taiwan and South Korea rely on imports for over 90% of their energy, mostly from the Middle East via the Strait of Hormuz. If the blockade continues, the semiconductor supply chain won't just take a direct hit. It will face a hidden second-order risk. Energy shortages will drive up production costs, which will in turn delay chip delivery cycles. That's exactly why the semiconductor sector has taken a pretty big dive over the last couple of days. Looking at today's market heat map, we are seeing a clear rotation into safety. The technology sector is taking a noticeable hit, bathed almost entirely in red. Megacaps like Apple, Microsoft, and Nvidia are all trending lower and weighing on the broader market. Conversely, the only real pockets of strength are in traditional safe havens. Consumer defensive, utilities, and the energy sectors are holding up incredibly well. You can see solid green across these areas as investors move capital away from high-growth tech and into these defensive, resilient assets. Looking at the current price action, the risk-off mood is thick, and the overall trend has broken down. A while back, we talked about our worry that the IWM might break below its consolidation box, bounce back up for a retest, and then head lower again. And as of today, the SPX has officially begun its battle to defend the 6,600 level. Next week is incredibly important. The market is going to price in whether the US-Iran conflict will turn into a prolonged war. If it does, all indices are going to face massive risks. Right now, a lot of people might feel that tech stock valuations are relatively reasonable or even cheap. I completely agree, but the capital market is realistic and cruel. Using this catalyst to pop the bubble might actually be a healthy correction. Nvidia is hosting an event from March 16th to 19th, and their CEO has been putting out quite a few articles and statements lately. Maybe that's why the QQQ is currently looking stronger than the other indices. We also have an FOMC meeting next week, which is going to be crucial. Let's get back to the charts. We are looking at QQQ right now. Although it's still moving within a box, it printed a big green candle on Monday that opened low and closed high. But, as I mentioned in my video back then, the volume was lacking, so we needed to be cautious. Now, it's back to the bottom of the box. Even though it was pulled back into the ICU, it hasn't been moved to a regular recovery ward yet. We are seeing the risk of a breakdown again, and the danger hasn't passed. Take a look at the weeklies. This week, whether it's QQQ or SPX, you can see they both printed very long upper wicks, shadows. The closing prices are near the lows. This shows the bulls wanted to push higher, but the bears overpowered them, and they couldn't hold those levels. Looking at IWM, it also has a very long upper wick, closing at almost the lowest price of the week. All these signs indicate that the current price action is not looking good. The risk is still high, which makes trading right now very difficult. We absolutely must reduce our trading frequency. Don't just chase every green candle you see. If we look back at Friday's session, the Dow and SPY already broke below their March 9th lows. QQQ and IWM haven't yet, but I think it's only a matter of time. The best trading logic right now is this. If you're already in, and the trend hasn't broken, just keep holding. But the moment it breaks below support, get out immediately. You have to be quick. Alternatively, just watch from the sidelines and hold cash. That is honestly the best strategy right now. When we talked about this candlestick a while ago, I mentioned it had already broken down from a double top M top. After breaking down, there's usually a pullback retest. Our fear was that it would head lower again after that retest. And that's exactly what is happening now. If this support can't hold, the downside space is very large. SPX has actually reached a support level, but this support zone is pretty wide. If it can't hold 6,600, the next support below is around 6,520. Looking at the current trend, the support at 6,600 is very weak, and a retest of 6,500 is likely. If QQQ can't hold this previous consolidation box, the support below is going to be very thin, and the drop could be quite deep. This isn't something we want to see. Because of all this, everyone must be careful. Trade as little as possible. Unless there's a very obvious pivot opportunity, sit on your hands. And when you do trade, be quick. Being quick means two things. Sector rotation is incredibly fast right now. A stock might spike and fade on the exact same day. Be quick to cut losses. If a breakdown is confirmed at the close, cut it without hesitation. Let's do a quick wrap up. The overall market right now is extremely sensitive to the wind. A bit of good news, and it shoots up. A bit of bad news, and it gets hammered down. Looking at the indices, they look primed to break down and head lower. For the S&P, I think the 6,600 level might not hold, and the major support below is at 6,500. Currently, the US stock market faces three major risks. First, we need to pay close attention to whether the conflict can end in the short term. Second, once SPX drops to 6,500, CT as commodity trading advisors will flip, which will trigger massive algorithmic selling pressure. Third, a risk many are ignoring is the Fed chair transition in April. This shift could lead to a temporary power vacuum at the Federal Reserve, potentially causing market chaos. Right now, the whole world has slowed down. Trying too hard and trading too frequently won't necessarily give you good results. Right, this is Lineup Stocks. I wish you all a great weekend. See you next week.